it will run for I think you saw a lot of emails during the holiday and so forth. So those who will apply automatically be qualified. I would not use any other strategies to say, I do not select one to understand. I just say the first 16 to apply, they automatically qualify, unless if we have a drop. Maybe I'll still announce to say, hey, there's one opening, which is there. Thank you very much.
Gotcha.
Thank you. Pleasure.
Awesome, awesome. Thank you, sir.
Oh, by the way, first semester you were having Mr. China's, isn't it? Yeah, we will be having you now. Thank you. Yeah. That is the actually.
Yeah. All right, awesome stuff. But you guys, how are you guys doing? How are you guys feeling after the first semester of third year? Is it looking like we are almost done with this thing?
Yeah.
For the degree? Are you excited? 6 more months, guys.
It's over. It's like 4, so.
There you go, even less.
Yeah.
Even less. It's been a journey, huh? It's been a journey.
So
No.
what my plan is for next year?
You have time to think about it. I think the biggest thing that you guys need to focus on is just getting through the next 4 months, and you know, taking it steady from there. Sure, you'll be fine. Fine. My advice to you is study further if you can, but yeah, all our situations are different, so. Yeah. But I think let me get into this. So today we're going to keep it light. We're just going to go into the theory of your learning unit 1. And your learning unit 1 is entitled Cost of Capital, right? And what you'll see is that a lot of the content that we're actually going over, you will see that we will actually go back to some of the stuff you've already done from either last semester or somewhere in your second year, okay? One thing I just want to highlight is that these are not my slides. This is from a good friend of mine who actually lectures the same module at the Sandton campus called Rudolph, not Ralph. Okay. Now, in terms of learning unit 1, these are the learning outcomes, the things that you guys need to be able to do or achieve once we have completed this learning unit. So firstly, explain the key assumptions that underlie cost of capital. You know, the basic concept of cost of capital. What is cost of capital? Just from your own knowledge, what are we talking about here? What are we referring to when we say cost of capital?
Cost to borrow.
The cost to borrow. And whenever we borrow something, what do we know outside of the amount of money that we're going to borrow? What do we know is going to be applied to that money? Interest. So in other words, your cost of capital is actually your interest. Does that make sense? Remember, we've always said the cost of money is the interest rate attached to what we must pay for that money. Does that make sense? So when we're talking cost of capital, we're talking about the interest rate, okay? Or a interest rate pertaining to a company, all right? That is obviously looking to get funding, okay? But in addition to that, there are specific sources of capital, right, that make up a company's cost of capital. What are we talking about? Debt, equity, okay. Also, if we're to expand that, you've got preference shares, right? So we've got different forms of funding, all right? And primarily they would fall into one of those two, either debt or equity. Okay, so second learning outcome is to determine the cost of long-term debt, okay, and the cost of preference share capital. Now, preference share capital, we know, it's not debt, all right? At the same time, it's not 100% equity. It's kind of like an in-between, right? Okay. You guys remember from business management, different types of ownership that you get, isn't it? You got preference shareholders, ordinary shareholders. So is there an advantage to having preference share capital over ordinary share capital?
You get paid first. You get paid dividend.
As the holder or as the preference shareholder, isn't it? But what about from a company's perspective? Why not just issue ordinary shares as opposed to preference shares? What's your incentive as a company? What's fixed amount? Yes. Okay, now preference shares can get complicated very quickly, right? Because you can have it as a fixed dividend that you're giving them. It can also fluctuate with the profits that were made. You can also get cumulative, where we say, oh, we didn't make much money this year, so we'll pay you next year. What we should have paid you this year and what we're going to pay you next year. Does that make sense? And you actually have all of these in your textbook. So you never know, they could bring that as a theory question. So do look into those different types of preference shareholder. But it's 100% correct in that typically the dividend that we give them is fixed. And because it's fixed, it means that if we make substantial profits, we get to keep most of those profits. And we just give them that fixed dividend. So can you see where the incentive is as a company, right? And then when it comes to ordinary share capital, right? It's very expensive for the company. Why is it very expensive for the company? Why is it an expense? And I literally mean it's an expensive source of funding for the company. Ordinary share capital. If we go into business and instead of going and borrowing from FNB, we actually say, look, we're going to put 100,000 of our own money. Why is that more expensive than going and just borrowing 200,000 from investing?
You know that even with ordinary shares, you're forced to pay a dividend.
No, they're not forced. You're not forced. But it's attractive if you do.
So you're saying, why is it more expensive relative to preference
Yes.
shares or just general?
More expensive in terms of preference shares, more expensive in terms of long-term debt. We can go either way. It's the most expensive.
So the only thing I can think of relative to long-term debt, not preference shares, is the dividends. Even if you tweak when and how you pay, it's perpetual.
Mm-hmm.
Whereas even long-term debts, like something like a bond,
Yeah.
it's 30 years. Unless you're Coke and you're issuing like a perpetual bond, it's gonna be a fixed time around. Whereas
Okay.
my own ordinary shares, I can die and my descendants will still be.
Yeah. Whoever your beneficiaries are. Mm-hmm.
That's but other than that, kind of like.
Okay. It's a fair answer. So yeah, there, but there's more to it. Now, when I say the source of capital is expensive, what am I saying in the most simplest terms? There we go. The interest is high, right? Are we all together now? So we're basically saying that ordinary share capital has the highest interest. Why does it have the highest interest? This is stuff you guys must be able to unpack. You guys are third-year financial management. We're looking at it from the perspective of the business. Because remember, it's the business that borrows or sources the capital, isn't it? So in terms of this learning unit, we're looking definitely in terms of the business.
We're not returns. Because in interest rates in a bank, for instance, of me as a, I want to invest in your company.
Yes.
If you're going to only offer me a projected 6% return on my shares, I can go and get something similar in the bank that's a lot more safe.
Yes.
So wouldn't you as a company want to project higher returns to attract a client? And would that not make it more expensive for the interest rates?
In a nutshell, yes. And here's the thing. When you and me invest our 100,000 into the business, you must remember that means we don't have 100,000 that we could go and buy a new car with, or we don't have 100,000 that we can go put a deposit on our house. So can you see we are foregoing making use of that money, which is our money. And so now we want more of a real significant return, which is what you're pretty much talking to. Does that make sense? So when you use ordinary share capital, it's going to be expensive rather than going to a bank or doing preference shares. Yes, you want to say something?
Sure, some questions. Is that like similar to like last semester we did something with liquidity theory?
Yes.
That people would prefer to have their money being more accessible to them. So that
Connected, definitely.
And then why is it the most expensive preference share? But obviously it needs to have a higher now interest rate to attract more people.
Yes.
But then with preference shares, as a person investing, the only benefit of preference shares that I think you like have to pay a dividend, I get paid dividends, and the fact that you get preference with regards to liquidation. So what's the difference?
So you started to answer yourself, which I think you also highlighted.
I was going to take a stab, yes. So going back to the opportunity cost thing, if I might have to wait 2-3 years to get paid dividends on the ordinary share, I would assume that the interest associated would be slightly higher than the preference share because it's paid more regularly.
Say again. You would assume that the interest rate is more.
The interest rate on an ordinary share
Is
be higher.
Because
The preference share is more predictable as a cash flow. So you have to be compensated for the fact that if she has a preference share, she might get paid every year.
yeah.
If she has a preference share, she might get paid every year. If I have an ordinary share, I may have to forego that thing for another year, 18 months.
You guys are definitely trading on it. Now I want a simple term for this thing. There we go. There's more risk with ordinary shares. Because also if the company tanks, what happens? You don't get anything. So can you see, we've forgone our own money in this business. We get paid last. And on top of that, if the business tanks, so it goes back to the fundamental thing you guys learned last semester, risk and return. For more risk, you get more return, or you should at least. So you're being compensated for them. Okay, right, awesome stuff. Okay, so learning outcome 3, calculate the cost of ordinary share capital and convert it into the cost of retained earnings and the cost of new issues of ordinary shares. So those are different formulas, all with the purposes of obviously just calculating what is the cost of capital, all right, this specific source of capital. And then you will see we then utilize the different sources of capital to work out your weighted average cost of capital, okay? And that's the whole purpose of this learning unit, to see what is the cost of the funding that we have acquired as a business. Why is that important? To know the cost of the funding that we have acquired.
Isn't that the minimum rate of return? Isn't that what you have to, like, whatever your operations are, that's how much you have to make?
100%.
Yeah.
Because we know that we need to ensure that we at least hit that cost of capital. It must be our minimum return so that we are not losing money. Because remember, what's our objective as financial managers is to ensure shareholder what?
Maximum shareholder.
Yes, to maximize shareholder wealth. So if our return from the business is less than the cost of the money we're borrowing or utilizing to fund our business activities, what's happening to shareholder wealth? Is being destroyed. Okay, right. So here, what do they say? The cost of capital reflects the company's average long-term cost of financing. Very important. So here, we're not really making use of current liabilities. Does that make sense? Okay. Then it also shows the rate of return required by the entity on capital investment projects, okay, required, which is what we were speaking to now. The company's share price remains unchanged and maintained at a current level, All right, this is assuming that we are either increasing shareholder wealth or at least maintaining it. Then the entity has ability to attract funding from capital providers, because obviously if we are creating a return, and this is what Thomas was speaking to earlier, if I've got a return of 12%, banks only offer 6%. Are people not going to come to us and be willing to invest in our business? They definitely will. Okay. Definitely as a company, because remember, you've got so many different investment vehicles. Okay, this is not out of the scope of your module, but bank is what you would call money market, okay, or near term. Oh, you guys actually covered this last. Yes. And now equities is obviously you're investing in companies, which is also more risky, and so therefore you must get more. Definitely, if you've got a company that's not doing that, steer clear. Okay, the concepts of cost of capital. So now we're touching on the first learning unit outcome or learning outcome. It reflects the company's average long-term cost of financing. All right, cost of capital financing. So that's the definition that you want to put if they ask you. All right, and then you add an e.g. Debt or e.g. Debentures. Maybe you want to be more specific so you can get your marks. E.g. equity, preference shares, ordinary shares, etc. Refers to the cost the entity incurs for raising capital. Okay. And remember, when we're talking cost, we're talking about an interest rate. Just be mindful of that. Companies' sources of capital include debt, preference shares, and equity. So we touched on this. Okay. Okay. Latter includes both retained earnings and okay. No, that's fine. We'll see that as we then look at equity financing. That's new share issues and so on and so forth. Now, here they then go on to speak on something. They take a bit of a deviation is what I'm trying to say. So they then go on to speak about business risk. Anybody want to tell me what is business risk? What is business risk? What are we talking about when it comes to business risk? And I'm just going to go on so you don't read. You tell me what you actually think. Business risk.
Would not be the risk of the owners of the company going into business.
I can agree with that. Don't write it in a test though.
Stuff associated with market conditions.
Market conditions. Yeah.
Like if I sell stuff wholesale, so no.
Internal risk within a business. Okay.
Could be there's taking out huge amounts of
So that would be more financial risk because we got the 2. In fact, usually you get 3, but in yours, it seems like they just spoke on the 2. If I'm not, no, you do have 3, but you don't have operation. So it's usually business, financial, and operation. And you guys are, you're there.
I don't know how to phrase it, but I think it lies in the market environment, the market environment.
So you guys are touching on specific things.
Yeah.
But to sum it up, you're looking at the nature of the business. Business risk is the nature of the business, pertaining to the nature of the business. So the market we operate in, both internal and external. Can you see what you're talking about is external? What she was talking about is internal. You both right? Because as a business, you obviously have both internal and external. All of that forms part of your business nature. Can you see that? Okay. So at the end of the day, you're looking at the risks that obviously would be posed to you as a result of the nature of your business. Okay. this is the risk of an entity failing to pay its net operating costs and continue as a going concern. Pause on that one. The probability of this risk depends on the nature of business activities and the type of investment projects it chooses to accept. Okay, so I would focus quite most of my time and energy on the first and the last bullet point. And the reason why I'm saying that is because you'll find that the second bullet point is quite closely connected to the second business risk, which is obviously financial risk. And financial risk is pretty straightforward. Here we're talking about, I think someone mentioned it, I don't know who it was, but when you're talking about being over leveraged, when you've got too much gearing, in other words, more debt than is ideal, more debt than assets, to be specific in relation to definition for gearing 100%. And obviously that puts you in a situation where you will fail to meet your financial obligations. Does that make sense? So financial risk, nobody should be losing marks there, okay? But there's more content in your textbook. So do have a read at that, be able to expand on that, because they can ask you 5 marks. I don't think they would go as far as 10 marks, but yeah, it can get lengthy. Is that what?
Economics is a lot of theory.
Is it? Yeah, no. I think all the financial numeracy related modules, the assessors are switching up their questions, so anything is possible. Yeah. Then the third thing they just mentioned here, it's not necessarily a risk, is after-tax costs are considered relevant. Somebody unpack, and you are more than welcome to read and then attempt to explain. What are we saying when talking about cost of right?
Does that not have to relate to CGT? Does
Say
it
again?
not relate to CGT?
CGT, you're talking about
Against this.
capital gains tax. Capital gains tax. I don't want to say no.
We're more talking about income after tax.
Income after tax. Yes. Remember, the big issue is here we're talking about cost of capital. Because I don't want to give it away.
Do not remove the tax effects on cost of capital.
From interest.
Yes. Wow.
Those in red.
There's no you can deduct it.
Yes.
It's accounted in red.
Say again.
They are counted in red.
Yes, the after tax costs. Remember what we're calculating is, and you guys, I'm just bringing together what you guys are saying. 100% of the money, right? Remember, we're calculating the cost of capital. In other words, the interest rate, the minimum interest rate that we must be able to pay so we don't lose shareholder wealth, isn't it? So, as you mentioned, there are deductions on interest, right? So we can deduct a portion of this. So is that a cost to us? If we can deduct that, it's not a cost to us. Can you see why it's only the after-tax cost that's now relevant? Because that is a real cost to us that we have to pay off in one way, shape, or form. Does that make sense? So that's all that we are really considering, or they're trying to highlight that's why the after-tax costs are relevant, because the before tax or the portion that is deductible, since it is deductible, it's not a cost to us. It's irrelevant, therefore. We together? No. Okay. Oh, I was like, ish, I don't have any more explanation left in me. So I'm happy. So here we are now at the cost of specific sources of capital. Okay, and we've touched on them. Okay, so the first one they're looking at is the cost of debt. Cost of debt. All right, and here obviously we're talking about the interest that is paid by the borrower, and in this case, being the company borrowing funds or sourcing funds, we are the borrower. Does that make sense? Okay, So debt refers to interest-bearing loans, which is raised either through sale of corporate bonds. Okay, so it's not always bank loans. Okay, or external bank loans. Now, what's the other word for corporate bonds? You guys learned about this. Hmm. Somebody even mentioned it in class today. The exact word. Should I give a hint?
Yes.
It begins with a D.
Debentures.
Debentures. Okay. What are debentures? Let's talk about debentures. What are they? And you can kind of look at, remember we said debentures is another word for the sale of corporate bonds. So you can, if you think of corporate bonds, how do we unpack?
The bond not necessarily used for someone that needs money to fund a project.
Someone being a company, right?
So they'll go into the, or
JSC.
something and go look for a bond and purchase it. And they'll obviously have to make other regular interest payments. And at the end of the bond, pay the full.
So they'll actually construct it and then make it accessible on the JSC or on the, what do we call it, NASDAQ. We're talking about in America, but 100% correct. And now the company, like Coca-Cola, you mentioned Coca-Cola earlier when you're talking about irredeemable. The company now must make those interest payments to whoever is the holder. So if you bought the debentures, now we must pay you. Does that make sense? And can you see? It's all just fancy English for the word loan. They're loans. You've given me a principal amount of $1 million. I'm paying you interest on that $1 million. And at maturity, I'm also going to pay you that $1 million back. Does that make sense? Can you see that? Of course, unless we're talking about irredeemable. So you'll see in finance, the higher you go as well, but I'm sure already you've come to realize it. We use fancy words for simple things. Okay, it's a loan that we create as a business instead of going to walk into FNB and say, can we have a loan? Okay, what's nice about this? Why would it be preferable, especially if you're a big company like Coca-Cola or Apple or the government, because you also get government bonds, isn't it? Why is it attractive to issue debentures as opposed to going and just getting a loan from the World Bank or wherever?
You set the terms.
Boom, there you go. You set the terms. You say we are willing to pay this level of interest. You can say 12%, you can say 6%. It's up to you. Does that make sense? So there you go. The cost of debt is a tool used by capital providers to examine the entity's financial health before providing loans. Okay. All right. Then here now, it's going to what we were discussing. Because I'm just going to look at the formula. We're talking about debt and taxation, isn't it? So RD, we know, is your before tax cost of debt. Okay. So how do we find the interest that we are going to pay? You guys did this last semester. Return divided by the principal, isn't it? Uh-huh. All right. So, I was just saying yes, but this is also expressing confusion. It's the first day. No, your third year is your season. First day, holiday, so good.
The season also just means time.
Season also means time. No, but don't worry. Today we are just discussing slides. We're just discussing theory. So it's fine. Okay, but I'll slow it down a little bit. So RD is your cost of debt before tax is considered, all right? So again, we can say, okay, we've got, we invested 100, we borrowed 100,000. Okay. And the interest payment or installment is 10,000. I want to keep it simple. So 10,000 divided by 100,000 gives you what percent? 10%, 100%, okay? It gives you 10%. But then we know that we have, it's deductible, isn't it? So we then say, no, but then what is our real cost as a company when we borrow this 100,000? Okay, because some of that 10,000 is deductible. So we then say, okay, cool. To calculate our cost of debt after tax, we then have to say, okay, one, obviously being 100%, minus whatever the tax rate is. Okay, and in this case, I believe 27%.
What's this?
Corporate rate. Yeah. Yeah. So you would then be saying 1 minus 27% times that 10%, which would then give you what? Somebody calculate. What would be your,
What's the calculation?
10% times 1 minus 0.27 in brackets.
So wouldn't it be 7.3?
Yeah, of course.
72% times 10.
10%.
73. Yes, exactly. Exactly. Yeah. So it's 7.3. 100%. Okay. So there you go. Now you know how to calculate your cost of debt after tax, which we know is that's the relevant thing for us. Okay. All right. So now here we're talking about, let me just see how many slides. I think we will.
It's 24, so.
Okay.
So when am I gonna upload this?
I'll do it today. I'll upload these slides today. So we were here, ne? Okay. So, in your finance 3A, you guys touched on whenever you have a perpetual, what do we call it? Perpetuity.
Yeah.
But there was another word before we. Return in perpetuity. What was it?
So this is the back end of the annuity section.
Yeah.
I just don't, like, the specific phrase you're looking for,
Yeah.
I can't pick up.
It's fine, but you guys are with me.
Yeah.
Okay. The only thing we're looking at is in 3A, we're looking at the return. Here now we're looking at the cost of capital. Does that make sense? So in 3A, we were saying we've invested in and we're getting until who knows, right? Here we're saying we are paying until, you know. All right. So yeah, that's all that I really want to highlight. So it's literally your interest payment per annum. All right. And here we're then saying the I there, why haven't they written it? Okay, well, it's your interest rate, and then obviously divided by the current market price of each unit of irredeemable debt. Okay, so yeah, but we'll see that when we start doing questions, which we'll see tomorrow. Okay, then redeemable debt, obviously, all we're talking about here is your pretty much your traditional loans, which have a end date. It must be paid off by X number of years. Okay. All right, and then obviously the current market value reflects the present value of forecasted cash flows attributable to the debt, all right, interest payment, and the redemption, in other words, the principal, which we also know as the nominal value. Okay, so to calculate the cost of redeemable debt, we determine the IRR through trial and error, all right, which I always recommend you do with a financial calculator. So write out your steps. This is how I recommend you guys do it. Write out your steps so we can see what you are trying to do. Because what some students do is they just do it in the financial calculator. they've got the right process. It's not like they off the mark. Does that make sense? But for some reason, they might get the wrong answer. And then we can't even give marks along the way. Does that make sense? So that's why I recommend make sure you write your steps out and then show us your logic and then give us your final answer. Okay. So yes.
So when you say write our steps, do you mean like our inputs?
Yes, your inputs, 100%. Yes, I, PV, future value. Okay, cost of variable or floating rate debt. Okay, so obviously you've got fixed and then you obviously have floating, and this is where now we really need to make sure that we practice, and then you'll be just fine. I actually forgot to go over something I wanted to do before even touching any content. Okay, but we'll get to that. All right. So the last slide that I want to look at here before we take a break is the cost of corporate debt. All right. Refers to a bond issued by a company, okay, which we spoke on earlier, debentures, okay. The proceeds include the cash received by the company, net of flotation costs, okay, underwriting costs, legal fees, and so on and so forth. So I haven't seen anywhere in your textbooks where they actually give you underwriting costs and legal fees. So that's more so you are aware, but I think in a question they wouldn't make it that technical where they say, okay, the business managed to, let's just call it, say, retrieve 1,500, but then they had underwriting and legal fees of 250, which means that the net that you got was actually 1,250. Does that make sense? So I don't think they would get that technical, but at least you are aware. Then the interest rate is yield to maturity, net of issue costs. So can you see here, you're basically just changing, you're basically looking for the interest on your financial calculator and then inputting all the other values. Does that make sense? You know your maturity is 5 years. You know the future value of the loan is whatever, and you know the present value is whatever. Can you see? Okay. So you just need to become really good friends with your calculator, be able to interpret the question. You should. Okay. But that said, I think let's take our 10-minute breather. Then when we get back, we will continue answering this. Yeah. I don't think we start.
Yeah, Merry Christmas.
For behind the brothers.
Kids.